Tech and SaaS Financial News Roundup, May 28, 2026. Disclaimer: the following content is strictly for informational and news purposes only. Nothing herein constitutes legal, medical, financial, or official advice. All stories are reported as news and analysis, not as guidance or recommendations. Do not treat any anecdotal story or commentary as advice. Topic 1. Cloud Alliances and Stock Surges, May 28, 2026. Snowflake Incorporated's latest earnings announcement sent shockwaves through the market as the cloud data platform provider's stock skyrocketed more than 35% in after-hours trading. The company unveiled stronger-than-expected quarterly results, outpacing Wall Street forecasts with revenue surging 34% year-over-year to $1.39 billion and a robust 39-cent adjusted EPS that nearly tripled analyst estimates. CEO Frank Slootman heralded the results as a clear turning point, citing booming demand for Snowflake's data cloud in the AI era and calling it a milestone quarter that put the company back on a high-growth trajectory. Beyond the impressive numbers, Snowflake also raised its full-year outlook significantly and revealed plans to spend $6 billion on Amazon Web Services over the next 5 years to accelerate its AI initiatives. This combination of a massive cloud commitment and upbeat guidance signaled renewed investor confidence in the firm's strategy, reversing much of the steep share price decline Snowflake suffered earlier in the year amid tech sector volatility. Snowflake's strategic alliance with Amazon's AWS underscored how cloud providers and data companies are forging deep partnerships in the race to power artificial intelligence workflows. The $6 billion multi-year deal effectively locks in Snowflake's infrastructure on AWS, ensuring huge cloud consumption as Snowflake expands its offerings into AI model hosting and agentic data tools that automate complex tasks. Analysts noted that Amazon gains a high-profile AI workload client to showcase its proprietary chips and cloud prowess, while Snowflake secures favorable terms and technical collaboration to support its rapid growth without building its own data centers. This symbiotic deal highlights a wave of similar tie-ups across the industry, where software companies are partnering with cloud giants for guaranteed capacity and advanced services to meet surging AI-driven demand. By aligning closely with AWS, even planning to adopt Amazon's custom silicon to boost performance, Snowflake is positioning itself to lead in enterprise AI data services. And the market clearly rewarded that bold bet with a dramatic stock price surge. The Snowflake rally and AWS agreement resonated across the broader tech market, fueling optimism that enterprise software companies can thrive by embracing AI and cloud synergies. Industry watchers observed that Snowflake's blockbuster quarter showed artificial intelligence acting as a powerful tailwind for new and existing customers, potentially catalyzing renewed investor enthusiasm for the battered software sector. The strong results also came as a relief to an industry that has faced investor skepticism. Snowflake shares had been down roughly 20% year-to-date before this earnings beat, but they are now set to erase those losses. Combined with other upbeat reports, such as Workday's solid earnings and a margin forecast bump driven by AI strength, Snowflake's success reinforced the view that the worst may be over for high-growth tech stocks. Major indexes tracking cloud and SaaS companies ticked higher in response, and a prominent investor declared on financial TV that the worst is over for software stocks, suggesting Snowflake's inflection point could mark a broader turnaround in market sentiment. In a single day, the narrative for enterprise software shifted from caution to confidence, anchored by the transformative potential of AI and strategic cloud alliances. Subtopic 1. Snowflake stock price surged by over a third following its latest earnings report and announcement of a multi-billion-dollar cloud partnership, a head-turning rally that signals resurgent investor excitement. The data cloud provider's shares spiked almost 36% in post-market trading on Wednesday after Snowflake beat analysts' expectations and raised guidance on booming demand from artificial intelligence workloads. This dramatic leap reversed months of decline for the stock, showing how quickly sentiment can flip when a leading SaaS firm demonstrates renewed growth momentum. Many observers see the spike as a sign that confidence in enterprise software is returning, driven largely by clear evidence that companies like Snowflake are successfully capitalizing on the AI boom. The rapid run-up underscores the market's hunger for tangible AI success stories after a period of skepticism, and Snowflake's overnight resurgence stands as perhaps the clearest example to date. The magnitude of the jump, adding tens of billions of dollars to Snowflake's market cap, is rare even in the volatile tech sector and has put the company back near its prior highs. For industry followers and investors alike, Snowflake's explosive gain in a single session became a focal point of conversation across trading floors and social media, underlining the potency of strong results tied to AI-fueled growth. Subtopic 2. At the heart of Snowflake's breakout performance was the revelation of a $6 billion partnership with Amazon Web Services to bolster Snowflake's AI capabilities, a blockbuster cloud alliance that sent shockwaves through the tech industry. This sweeping multi-year deal commits Snowflake to significantly expanding its usage of AWS infrastructure, in exchange for advanced cloud services and likely volume discounts that support Snowflake's foray into hosting AI-driven applications. The arrangement effectively deepens Snowflake's dependence on AWS while granting it access to Amazon's cutting-edge computing power, including custom chips optimized for artificial intelligence tasks. Analysts described the deal as a win-win. Amazon secures a marquee data partner embracing its platform, and Snowflake gains the scale and technology needed to underpin the next wave of its growth, all without investing in its own data centers. Investors responded enthusiastically to this news of tight collaboration between a rising enterprise software star and a public cloud titan, interpreting it as a powerful validation of Snowflake's strategy and a sign of how vital AI workloads have become in the cloud business. The partnership's massive price tag is one of the largest seen for a customer cloud vendor commitment, underlining the extraordinary cloud consumption anticipated as AI demands ramp up. In many ways, Snowflake's AWS alliance has become a symbol of the new era, companies ready to spend billions for strategic cloud capacity to secure an edge in artificial intelligence. Subtopic 3. Market watchers quickly framed Snowflake's blockbuster results and cloud deal as a potential turning point for the entire cloud software sector, long weighed down by rising interest rates and growth jitters. Analysts and commentators noted that this milestone quarter could rekindle optimism across enterprise tech stocks, as Snowflake's success demonstrates that leveraging AI can reinvigorate even previously struggling software names. The notion that artificial intelligence can lift all boats gained ground after Snowflake erased its 2026 losses in a single evening, encouraging investors to reassess beaten-down SaaS valuations more broadly. On Wall Street trading desks, there was speculation that Snowflake's overnight comeback might spur a re-rating of cloud stocks, shifting the narrative from concerns about overvaluation to excitement about new growth engines powered by AI. Indeed, beyond Snowflake, indexes tracking software companies ticked higher on the news, and sentiment improved for peers in data analytics, cloud services, and business software. Some high-profile market voices went so far as to say Snowflake's triumph shows that the SaaS slump may be in the rearview mirror, provided other companies can similarly harness AI trends. After a long stretch of caution, Snowflake's big win ignited a sense that enterprise software's prospects are brightening in tandem with the accelerating adoption of artificial intelligence. Subtopic 4. In a surprising adjacent development, Meta Platforms CEO Mark Zuckerberg hinted that the social media giant is contemplating entering the cloud services business, a revelation that turned heads and added intrigue to the competitive cloud landscape. In remarks that drew immediate notice, Zuckerberg said a Meta-run cloud computing service was definitely on the table, a statement that set off speculation about how Meta might leverage its vast infrastructure and AI expertise to challenge entrenched players like Amazon, Microsoft, and Google. While Meta has not formally announced a cloud offering, the mere suggestion from its chief executive underscores how lucrative and strategic the cloud market has become in the AI age. Industry insiders note that Meta's massive data center network, built to power Facebook, Instagram, and WhatsApp, could potentially be repurposed or expanded to serve external enterprise clients if the company chose to pivot in that direction. If Meta were to launch a commercial cloud platform, it would be an unprecedented move by a social media behemoth diversifying beyond its core consumer apps. Though still hypothetical, the prospect of another trillion-dollar company eyeing the cloud space highlights the intense scramble among tech giants to dominate the foundational computing layer that underpins modern AI and digital services. Zuckerberg's remarks, coming on the heels of Snowflake's AWS deal, reinforce the view that the battle for cloud supremacy is entering a new phase, with even new entrants considering joining the fray. Subtopic 5. Meanwhile, Google's own push to expand global AI infrastructure has encountered real-world hurdles, as evidenced by local concerns surrounding its planned $15 billion data center project in India. A prominent report revealed that Google's ambitious strategy to build a massive AI-focused data center hub in the city of Visakhapatnam is facing backlash from residents and activists due to worries about water usage and environmental strain. Data centers, especially those built to power large-scale AI computations, consume enormous volumes of water and electricity for cooling and operation. And Google's planned facility has sparked debate over its impact on a region already grappling with water scarcity. The controversy highlights an often overlooked side of the cloud computing boom: the infrastructural and environmental costs of the race for more GPU-driven computing capacity. While India is keen to attract big technology investments, projects of this magnitude are drawing increased scrutiny from communities balancing economic benefits with sustainability concerns. Google has pledged to incorporate greener practices and advanced cooling technologies, but the tension underscores how AI's growth is intersecting with broader societal and ecological issues. As more hyperscale cloud projects break ground worldwide to meet AI demand, debates like this one in India illustrate the complex trade-offs tech companies must navigate as they expand their global footprint. Subtopic 6. The common thread running through these developments is the fierce competition to secure cloud dominance in the AI era, a land grab marked by staggering multi-year contracts and escalating commitments from both providers and customers. Tech firms are recognizing that in order to harness the full potential of artificial intelligence, they must lock in reliable access to massive computing resources, and they are increasingly willing to sign bigger and longer deals to do so. Cloud service providers, for their part, are offering attractive terms and early access to innovative hardware or services to entice key customers into deep partnerships. The result is an industry-wide acceleration of deal-making. Multi-billion-dollar agreements like Snowflake's AWS tie-up are becoming the strategic playbook for those who can afford them. Each major contract signals a bid to outpace rivals by ensuring there are no bottlenecks in scaling AI applications, effectively making cloud capacity a competitive weapon. This trend reflects a new reality where the boundaries between software developers and cloud platforms are blurring through alliances, all aimed at cementing an advantage in delivering AI-driven solutions. In the coming years, analysts expect these colossal partnerships to multiply, fundamentally reshaping market dynamics as companies vie for an upper hand in computational might. Subtopic 7. Indeed, a growing body of market research suggests that the enterprise software field remains on a strong long-term trajectory, with artificial intelligence providing an additional boost atop already solid fundamentals. One newly released industry forecast projects the global software-as-a-service market will grow from roughly $465 billion in 2026 to over $1.2 trillion by 2032, implying robust double-digit compound annual growth despite recent market gyrations. The same analysis highlights that AI-enhanced services are expected to account for an increasing share of this expansion as businesses worldwide invest in smarter software to drive productivity. While overall SaaS growth is moderating from the frothy pace of a few years ago, the consensus still foresees a high-growth decade ahead, especially for companies leading the charge in AI integration. Notably, nearly half of SaaS firms now employ usage-based or consumption-linked pricing models, which can accelerate revenue as customers' usage grows with AI adoption. These underlying economic trends provide an encouraging backdrop for the sector. Even after the ups and downs of financial markets, the demand for cloud-native, AI-powered software appears poised to propel the industry to new heights. For investors and technologists alike, the horizon for enterprise software is bright with multi-year promise, underpinned by a convergence of mature cloud infrastructure and innovative AI capabilities. Topic 2. The AI features arms race in SaaS. From fledgling startups to cloud behemoths, enterprise software providers are racing to infuse their products with artificial intelligence, transforming how businesses work almost overnight. There is a palpable urgency in the tech industry to retrofit every application category with generative AI or automation capabilities, an arms race in which no company wants to be left behind. Just as the internet era once forced companies to go digital, the AI era is compelling software vendors to augment their platforms with machine intelligence, often to the cheers of investors and customers alike. In recent days alone, multiple enterprise tech players unveiled new AI-driven features aimed at eliminating manual drudgery and boosting productivity. The widespread and near-simultaneous push by so many firms highlights a new reality. In 2026, AI has become table stakes for software, and those who fail to adapt risk irrelevance in the face of more intelligent, automated competitors. Concrete examples of this trend abound in the current news cycle, underscoring how quickly the competitive dynamic is shifting. Just today, prominent SaaS security provider AppOmni announced the launch of Marlin AI, an autonomous AI engine designed to hunt through corporate software-as-a-service applications for security incidents and automatically suggest or execute fixes. At the same time, an email security startup called Ocean emerged from stealth with a $28 million funding round led by Lightspeed Venture Partners, raising capital to scale its own AI-powered threat investigation platform for corporate communications. These two developments, a mature vendor enhancing its product with AI and a new entrant raising significant cash on an AI-centric promise, exemplify how the market is rewarding solutions that leverage artificial intelligence to solve old problems in novel ways. Both companies explicitly tout the ability of their AI systems to reduce human workload, whether by automating breach response or accelerating incident investigations in complex cloud environments. It's a testament to how enterprise customers, fatigued by alert overload and manual processes, are now seeking intelligent automation and are willing to invest in it. Crucially, the shift toward AI-enhanced software isn't limited to niche products. It extends to the very core of the enterprise software world, where established giants are reporting remarkable success by going all in on AI. Salesforce, one of the original SaaS titans, revealed that bookings for its new AI-driven offerings have reportedly tripled quarter over quarter, contributing to an artificial intelligence-related annual recurring revenue now exceeding $2.9 billion. Similarly, Workday, known for its finance and HR cloud suites, noted an explosion in client adoption of its freshly introduced AI assistant features, with more than 4,000 customers using at least one such agent just months after launch. These incumbents underscore the payoff of rapid AI integration. What might have been incremental feature upgrades in the past have become headline-grabbing growth drivers. In fact, Workday's co-founder Anil Basri bluntly stated that adding the 150th feature to HR software would do little, whereas adding an AI agent yields major business impact, a sentiment increasingly echoed across boardrooms. The net effect is that the competitive frontier in SaaS has shifted. Success is no longer measured by the sheer breadth of features, but by how intelligently and autonomously those features can operate. By all indications, the winners of this new arms race will be those companies that manage to seamlessly blend AI into their offerings and deliver real results for their users, leaving more static rivals in the dust. Subtopic 1. Enterprise SaaS security provider AppOmni made waves with the debut of its new Marlin AI product, an autonomous artificial intelligence engine for detecting and responding to threats in cloud applications, exemplifying how vendors are racing to automate cybersecurity. The just-launched Marlin AI is designed to monitor sprawling SaaS environments for suspicious activity around the clock, investigate anomalies at machine speed, and even propose or execute remediation steps to plug gaps before breaches occur. This kind of proactive, AI-driven security marks a departure from traditional tools that merely generate alerts for human teams to handle. AppOmni's rollout of Marlin comes as companies face a tidal wave of threats targeting their cloud software stacks, and many believe only AI has the speed and scalability to counter these modern attacks. By embedding continuous learning algorithms and agent-like investigative functions directly into their platform, AppOmni is aligning with a broader industry push to use AI as a force multiplier for overburdened security teams. Early customer interest reportedly spiked, and industry analysts lauded the move as a smart bet in a climate where businesses are prioritizing any solution that reduces manual workload and fortifies defenses. Marlin AI's launch highlights how established SaaS players are not idly watching the AI revolution. They're harnessing it to solve critical challenges and stay ahead of the competition. Subtopic 2. Illustrating the fervor around AI-powered solutions, email security startup Ocean emerged from stealth with a $28 million funding round led by Lightspeed, aiming to turbocharge corporate cybersecurity through intelligent automation, cashing in on investors' hunger for AI-driven upstarts. Ocean's platform applies artificial intelligence to quickly detect and investigate email threats like phishing and business email compromise, a task historically handled through labor-intensive manual analysis. The substantial early funding reflects venture capitalists' strong conviction that automation and AI represent the future of enterprise security, where human analysts alone can no longer keep up with the sophistication or volume of modern attacks. That a young company can raise an eight-figure sum essentially on the promise of an AI-first approach shows just how eager the market is to back innovation in this space. Ocean's coming out party on the same day as AppOmni's product launch underscores a theme. Both incumbents and newcomers are charging full speed into AI for security. The willingness of major investors to write sizable checks for yet-to-be-proven AI startups like Ocean signals that, at least for now, there is a belief these technologies will be game-changers in enterprise software. For customers, it means a growing roster of AI-armed solutions to evaluate as they seek to protect their digital assets more effectively. Subtopic 3. Perhaps the most striking evidence of the AI arms race paying dividends comes from the industry's giants. Salesforce disclosed a jaw-dropping increase in demand for its new AI capabilities, reporting that bookings tied to its AI offerings have tripled in just one quarter, an unprecedented acceleration for a company of its size. These bookings, which helped push Salesforce's annualized AI-related revenue to nearly $3 billion, reflect surging enterprise interest in tools like the company's Einstein GPT and other generative AI features integrated into its CRM platform. Salesforce's leadership has been vocal that integrating AI deeply into their products is central to their strategy, and now the financial results appear to vindicate that approach. Wall Street analysts and shareholders took notice of this dramatic growth, seeing it as proof that even mature software businesses can unlock new expansion and renewed relevance through AI. Once considered a pioneer of the cloud era, Salesforce has effectively reinvented itself for the AI age, demonstrating that legacy can be a strength when paired with timely innovation. As a result, Salesforce's stock and peers across the SaaS space have enjoyed a tailwind from the company's AI success, with many investors treating it as a bellwether for how established enterprise vendors can navigate and prosper in this period of rapid technological change. The overarching message is clear: adapt and innovate with AI, or risk falling behind in the evolving landscape. Subtopic 4. Similarly, Workday, the cloud enterprise software vendor for finance and HR, recently highlighted how its swift embrace of AI is driving tangible business outcomes and shaping strategy going forward. Another signpost of how critical AI has become even in traditionally slower-moving software domains. Workday reported that over 4,000 of its customers have started using the company's new AI assistant features, more than doubling from the previous quarter. And that annualized revenue tied to these agentic AI solutions is approaching $500 million in a matter of months. Company executives have made it clear that such compelling uptake of AI functionality in tasks like talent management and financial planning is changing the game. Customers are increasingly expecting these intelligent capabilities, and delivering them is directly linked to stronger customer retention and upsell opportunities. On a recent earnings call, Workday's co-founder and newly returned CEO Anil Basri openly stated that incremental traditional features no longer move the needle, whereas each new AI-driven capability can significantly boost the product's value. That candid admission encapsulates the broad pivot happening in enterprise software. Innovation is now synonymous with artificial intelligence integration. In short, AI-savvy offerings are becoming a prerequisite for success, and Workday's example underscores that point clearly. Subtopic 5. The drive to add generative AI assistance and automation extends across virtually every category of productivity, creative, and enterprise software, a trend so pervasive that experts have begun calling this the era of AI in everything. Giants like Microsoft, Google, and Adobe have all rolled out broad platforms of AI features, from coding copilots in developer tools to writing and image generation assistants in Office and design suites. This cascade of AI infusion from the top down has set a precedent that smaller software companies are scrambling to follow. 2 years ago, an AI assistant baked into a product was a novelty. Today it is quickly becoming an expected standard. Across customer relationship management, project management, IT operations, content creation, and beyond, companies are finding that customers now ask, "What's your AI strategy?" as part of evaluating any vendor. The pressure to deliver effective AI capabilities has essentially become a condition for competitiveness. This widespread phenomenon underscores that the AI feature arms race is not confined to one corner of tech. It is a sweeping transformation affecting nearly every software tool companies and individuals use. Subtopic 6. It's clear that the bar for enterprise software is being reset by the accelerated adoption of AI. User expectations are shifting, and vendors must adapt their roadmaps accordingly, or risk falling behind. Today's business users are beginning to assume their applications will come with an element of intelligence, whether it's a chatbot that can draft content, an algorithm that can predict sales trends, or a process automation that eliminates repetitive tasks. What was once the realm of science fiction, software that learns and acts autonomously, is becoming part of everyday workflows. The competitive implications are profound. Companies now find that the addition of AI-driven capabilities can meaningfully differentiate their offerings, whereas failing to offer them can give the impression that a product is outdated or less valuable. This dynamic spurs further innovation as firms leapfrog one another with new intelligent features to attract and retain customers. In essence, artificial intelligence is turning into both the new user interface and the engine of enterprise software. Its rapid proliferation is pressuring every player to keep up if they want to remain relevant in the evolving tech landscape. Subtopic 7. For all the enthusiasm, this rush to implement AI features comes with significant challenges and responsibilities that companies are navigating on the fly, a necessary consideration even amid the hype. As more processes are handed over to algorithms, questions of trust, accuracy, and security inevitably follow. Businesses need assurances that AI decisions are reliable and won't introduce new risks. Industry watchers have cautioned against AI washing, a phenomenon where companies slap the AI label on features without truly delivering advanced functionality, potentially eroding customer trust over time. To address these concerns, leading SaaS providers are emphasizing transparency and investing in robust evaluation of their AI models, mindful that over-promising capabilities could backfire. Moreover, with regulators paying closer attention to AI's risks and biases, vendors are working to implement guardrails, for example, by limiting AI systems to well-defined tasks or incorporating human review for sensitive outputs. Thus, the AI feature arms race has a dual mandate: move fast enough to innovate and capture value, but also ensure that the technology lives up to its claims and is deployed responsibly. In the heat of competition, balancing these needs will test even the most forward-thinking software companies, as they shape a future where AI and applications is both powerful and carefully managed. Topic 3. Venture capital mania and sky-high valuations in AI. Investors are pouring unprecedented sums into tech companies riding the wave of artificial intelligence, fueling a hyper-competitive funding environment that has drawn comparisons to the dot-com boom. Over the past year, valuations for AI-focused startups have skyrocketed as venture capital firms, hedge funds, and corporate backers race to stake claims in what they see as the next transformative technology cycle. Daily news in the tech sector now regularly features funding announcements with eye-popping numbers and soaring valuations. This frenzy reflects both tremendous optimism about AI's potential to reshape industries and a fear of missing out mentality gripping capital markets. However, it also raises questions about sustainability and whether some of these investments may be overshooting reality. The landscape is one of exuberance, with entrepreneurs seizing the moment to scale ambitious projects, while seasoned observers caution that frothiness is building. The staggering scale of recent deals illustrates just how intense the AI venture mania has become. One striking case, disclosed today, is the startup Cognition, which raised over $1 billion in fresh capital at a valuation of roughly $26 billion. A valuation more than double what it was just 8 months ago. Cognition, the company behind an autonomous AI coding agent known as Devin, has seen its worth explode from $10.2 billion to $26 billion in less than a year as investors scramble to back any enterprise that could automate software development itself. This massive upround represents the kind of heady optimism that has venture capitalists writing enormous checks on the assumption that AI automation of core tasks, like coding, will unlock completely new markets. Such confidence in Cognition's potential speaks to the prevailing sentiment in Silicon Valley right now: bold bets on AI, with little apparent concern for short-term profitability, because the perceived long-term prize is so vast. It's not just one-off cases. A flurry of investments underscores the breadth of this gold rush. The same day, a European cloud computing firm called Nebius saw its stock jump over 9% after an ex-OpenAI researchers hedge fund disclosed a sizable stake in the company. The fund, run by a former OpenAI team member, clearly signaled its conviction by acquiring over 12 million shares of Nebius, fueling a surge that continues a trend of AI-related stocks vastly outperforming the market. Nebius itself had already been on a tear, up nearly 150% year-to-date as it lands major deals to provide cloud infrastructure for AI heavyweights. This example demonstrates how even public markets are not immune to the fervor. A mere mention of high-profile investor interest can send an AI stock soaring, reinforcing the cycle of excitement and drawing more capital toward that sector. Subtopic 1. AI infrastructure startup Cognition raised more than $1 billion in new funding at a staggering $26 billion valuation, a meteoric jump from its $10.2 billion price 8 months ago, highlighting the feverish investor appetite for AI moonshots. This outsized financing round means the company behind, Devin, an autonomous AI software engineer agent, nearly tripled in value in less than a year as venture capitalists jostled to own a piece of the emerging AI coding revolution. Cognition's raise is one of the largest ever for a private software startup and epitomizes the present gold rush in AI investments, vast amounts of capital chasing a still early technology with the hope of game-changing returns. Industry observers note that such a rich valuation, more than $25 billion for a firm still pre-revenue, reflects extraordinary expectations of future dominance. For now at least, investors show little hesitation in backing bold AI visions at lofty prices. The story of Cognition's funding bonanza underscores both the opportunities and the extreme optimism characterizing today's tech capital markets. Subtopic 2. In another sign of the times, Nebius, a cloud computing provider, saw its stock pop nearly 10% in pre-market trading after a former OpenAI researchers hedge fund revealed a big stake. The kind of news that can send shares of anything AI-related into overdrive. The hedge fund, tellingly named Situational Awareness, was founded by a one-time AI safety researcher from OpenAI and disclosed ownership of over 12 million Nebius shares, representing a 5.6% stake. Such a high-profile endorsement triggered a rush to buy Nebius, continuing a trend in which ex-OpenAI personalities now wield outsized influence in capital markets. Nebius, which provides cloud and AI compute services, had already secured massive deals with partners like Meta and NVIDIA earlier this year, fueling a 149% year-to-date gain prior to this latest bump. Market commentators see the event as emblematic of how AI's halo effect can dramatically boost companies seen as picks and shovels providers in the current boom. Essentially, just the hint of association with top AI talent or money has become sufficient to send investors clamoring. Subtopic 3. The venture funding frenzy isn't limited to mega raises and public stakes. It extends even to niche startups focusing on infrastructure at the intersection of AI and physical technology. For instance, London and San Francisco-based Orbital Industries just secured a $50 million Series B to develop advanced materials for AI-focused data centers, including cooling and power systems optimized for the intense demands of machine learning hardware. That a relatively specialized AI materials firm can attract eight-figure backing is illustrative of the broadening scope of where capital is flowing. Investors increasingly believe that the entire ecosystem of AI, from chips to software to support infrastructure, offers ripe opportunities for outsized returns. Orbital's pitch to improve the efficiency and resilience of AI data centers clearly resonated with funders concerned about the ballooning costs of running large AI workloads. The deal shows that beyond hyped consumer-facing AI apps, there's big money chasing more under-the-radar companies building the enabling hardware and physical tech needed to support the AI revolution. Subtopic 4. Hard data on enterprise IT spending confirms the magnitude of this shift toward AI, providing context for why investors are so eager. A newly released industry report indicated that corporate spending on AI-enabled software has jumped 108% year-over-year, as businesses dramatically boost budgets to integrate artificial intelligence into operations. This kind of exponential growth in demand for intelligent software and infrastructure has effectively thrown fuel on the fire of investor optimism. If enterprises are indeed doubling their spend on AI tools in a single year, venture capital wants to double or triple down on funding the suppliers of those tools. The report's findings quantify what less formal signals have suggested, that even amid broader economic uncertainties, companies are prioritizing technology that can make them more efficient or innovative via AI. With billions of dollars suddenly flowing into AI purchases by corporations, the logic follows that startups positioned to meet those needs will see their valuations inflate correspondingly. Subtopic 5. While enthusiasm reigns, a number of seasoned voices are warning that the current funding climate bears striking resemblances to past bubble periods, cautioning that not every astronomical valuation will be justified. Some analysts compare the present fervor to the late 1990s internet boom, when money chased sweeping promises with scant evidence. They note that many newly minted AI unicorns have yet to generate revenue or prove their tech at scale, raising the risk of overvaluation if the reality of execution falls short. In conversations across Silicon Valley, the term AI bubble is invoked with increasing frequency, usually followed by the caveat that no one knows how far the wave can go before rationality reasserts itself. Nonetheless, prudent investors are urging due diligence and a focus on business fundamentals even as the market rewards anything with an AI angle. The uneasy undercurrent suggests that, along with excitement, an awareness is growing that today's sky-high prices and abundant capital could eventually correct if results don't keep up with expectations. Subtopic 6. Capitalizing on the boom, early stakeholders in top AI companies are taking opportunities to lock in gains. For example, OpenAI employees reportedly sold $6.6 billion worth of shares on the secondary market, cashing out a portion of their holdings amid surging valuations for the artificial general intelligence leader. This enormous liquidity event effectively allowed insiders to realize some profits at a valuation rumored to be over $80 billion for OpenAI, demonstrating how even private companies are finding ways to convert paper wealth into real money during the mania. The sale highlights the ripple effects of investor demand. External capital was so eager to invest in OpenAI that it facilitated a massive buyout of employee stock, rewarding the employees and earlier investors. Such transactions stand as yet another indicator of extraordinary times, when one of the biggest deals in tech involves employees of a not-yet-public company selling billions in shares to hungry backers downstream. It underscores a climate where sources of capital are willing to do whatever it takes to participate in AI's upside, even if it means purchasing from insiders rather than directly funding the company in a traditional round. Subtopic 7. The AI investment fever is spreading into virtually every sector as venture funds and corporate venture arms hunt for promising applications of artificial intelligence beyond core tech infrastructure. Whether it's AI in healthcare, finance, education, or manufacturing, 2026 has seen a flood of specialized startups in each vertical raising significant rounds and commanding attention. From drug discovery platforms using AI to find new molecules, to fintech startups employing machine learning for risk modeling, investors are placing bets across the board that AI will reinvent business models and generate new winners. This broader reach of AI mania means that even industries historically considered slow to adopt tech are now part of the venture excitement. Moreover, many large investment firms are setting aside dedicated war chests for AI opportunities, ready to jump into late-stage funding of the next OpenAI or Anthropic as soon as they think the time is right. In short, the frenzy has created a sense that no company can be too ambitious or too niche. If it's focused on artificial intelligence and shows traction, the money will come. As the tech world watches this capital supercycle unfold, all eyes are on which bets will eventually pay off and which might become cautionary tales of exuberance. Topic 4. Tech IPOs reopen as big names eye public debuts. After a prolonged drought in tech initial public offerings, signs of life are returning to the IPO market and potentially in dramatic fashion. For the past couple of years, high-growth startups and tech unicorns largely stayed on the sidelines amid volatile markets and rising interest rates, leading to a dearth of major listings. But that appears poised to change. Investor sentiment is recovering, and several blockbuster companies are now preparing to go public, promising to re-energize capital markets. The news cycle is increasingly peppered with reports of tech firms dusting off their IPO paperwork or contemplating listing timelines sooner rather than later. Analysts describe this as the reopening of the IPO window for the tech sector, with pent-up demand from both companies that need liquidity and investors hungry for fresh high-growth stocks. This renewed momentum is likely to be punctuated by a series of big-name debuts that could kick the door open. Topping the list is SpaceX, Elon Musk's private spaceflight giant, which is widely expected to stage a historic public offering in June. SpaceX going public would be one of the largest and most anticipated IPOs in recent memory, and an unmistakable signal that the market is receptive to bold tech listings once again. Additionally, multiple high-profile AI companies are rumored to be lining up offerings. OpenAI and Anthropic, two of the most valuable private AI labs, are reported to be considering public debuts later in 2026. Investment funds are already positioning cash reserves to participate in such marquee listings, reflecting an excitement reminiscent of past tech waves. Collectively, these potential entrants hint at a cascade effect that could see dozens of smaller tech players also step forward to list, rejuvenating a pipeline that was largely frozen since 2021. Subtopic 1. SpaceX is reportedly finalizing plans for an IPO in June 2026, setting the stage for one of the most momentous stock market debuts in a generation. A milestone that could single-handedly revive tech IPO activity after years of stagnation. Elon Musk's rocket company has long been the subject of speculation regarding a public listing, and multiple sources indicate that SpaceX's historic offering is imminent with a targeted early summer date. If it proceeds, SpaceX's IPO would inject massive liquidity and excitement into markets, potentially valuing the space pioneer in the hundreds of billions of dollars given its near monopoly in commercial space launch and ambitious Starlink satellite broadband business. Investors across Wall Street have been keenly awaiting this event, many earmarking capital specifically to get a slice of SpaceX at launch. Should the IPO prove successful, it's widely expected to open the floodgates for other unicorns that have held back amidst unfavorable conditions. In effect, SpaceX going public is seen as the test case that will either confirm or allay fears about investor appetite for big tech offerings in 2026. Subtopic 2. Database and analytics provider ClickHouse unveiled striking financials that put it firmly on the path to a public listing within the next couple of years. Evidence that up-and-coming enterprise tech stars are preparing to tap public markets again. The 5-year-old company disclosed that it has crossed a $250 million annual revenue run rate, tripling its business from the prior year, and earlier this year raised funding at a $15 billion valuation. ClickHouse's rapid growth and hefty private valuation position it as an attractive IPO candidate once conditions permit, and leadership has hinted they envision going public as soon as the window is flung open. Industry observers note that ClickHouse even brought on a seasoned CFO from Snowflake, widely interpreted as another step toward an eventual IPO. With the IPO climate improving, companies like ClickHouse provide a preview of the next generation of enterprise tech floats, profitable or fast-growing SaaS firms with massive addressable markets. The prospect of such names listing has investors eagerly scanning the horizon, expecting a wave of debuts that could include enterprise infrastructure leaders similar to ClickHouse. Subtopic 3. The rumored public debuts of OpenAI and Anthropic, two crown jewels of the AI world, later this year have the market on edge with anticipation, hinting that the IPO pipeline might soon host some of the most valuable tech companies ever to go public. Both AI labs are reportedly evaluating late 2026 or early 2027 timelines for a listing, contingent on market conditions remaining supportive. Should OpenAI, with its viral ChatGPT and enormous partner backing, decide to list, its valuation could be record-breaking for a company of its age. Anthropic, likewise, has scaled fast in the generative AI space and could command a multi-decabillion valuation. The mere possibility of these offerings is driving excitement among institutional investors who missed out on early stakes and now see the IPO as their chance. In a broader sense, the expectation of such blockbusters joining public markets signals confidence that the mid-decade environment will support aggressive valuations and that companies are no longer indefinitely deferring going public. These AI giants are likely to lead a cohort of soonicorns, soon-to-be unicorns, on the verge of listing. That could make late 2026 a banner period for tech flotations. Subtopic 4. Beneath the mega names, a host of mid-sized tech firms are quietly preparing S-1 filings and meeting with bankers, encouraged by the improving conditions and marquee IPOs on the horizon. A clear indication that the tech IPO pipeline is finally unclogging. Executives at enterprise software and fintech startups that were IPO-ready in 2022 but held off are now dusting off their plans, expecting investor receptivity to be far better in the coming quarters. The overall climate shift, including stabilizing inflation, plateauing interest rates, and recent stock rallies, has reduced the fear that new growth stocks will be shunned. As a result, one can expect a steady trickle of filings once the first high-profile deals, like SpaceX, prove successful. Analysts foresee that 2026 could see more tech IPOs than the past 2 years combined, as pent-up supply meets returning demand. For public market investors, this means a broadening menu of growth stories to choose from after a long famine. And for tech companies, it means a chance to raise public capital and reward early backers, something many have postponed but are now eager to do in the reopening window. Subtopic 5. Tech investors have been eagerly stockpiling cash reserves in anticipation of these prominent IPOs, signaling just how much latent demand there is for new offerings. After a slim selection of tech IPOs in 2024 to 2025, many growth-focused funds and institutions have underallocated to fresh high-growth opportunities. Now, reports show that multiple funds are specifically setting aside money for the likes of SpaceX, OpenAI, and other upcoming listings, not wanting constraints when it comes time to buy. This dynamic represents a reversal from a year ago, when cautious sentiment had funds pulling back from IPOs. The groundwork being laid by investors suggests that when these companies do float, there will be significant capital ready to absorb shares, a positive sign for stable post-IPO performance. Some analysts even predict big oversubscriptions, demand far exceeding supply of shares, if current interest holds, which could bode well for first-day pops and positive momentum. All told, the reemergence of an IPO pipeline is not a one-sided decision by companies alone. It's being actively encouraged by investor readiness and appetite. Subtopic 6. The broader market backdrop has played a crucial part. Tech stocks have staged a strong rebound in 2026, with marquee names rallying and volatility subsiding, creating a far more welcoming environment for new entrants than the choppy climate of the past 2 years. Lower volatility and gradually improving economic outlook have given private companies and their bankers the confidence that they can achieve sensible pricing on IPO day rather than risking a disappointment. Additionally, interest rates, which surged in 2022 and hammered tech valuations, appear to have stabilized, making long-duration growth stocks more appealing again. If inflation continues cooling and central banks pause or ease monetary policy, it could further boost equity markets and pave the way for a flurry of tech listings. In effect, the macro conditions that slammed the door on IPOs are now swinging back to a neutral or even positive stance. This shift provides the green light many CFOs were waiting for before committing to go public. Subtopic 7. The impending wave of tech IPOs is expected to reshape market indices and bring a fresh injection of innovation to public markets, with potentially mixed implications. On one hand, retail and institutional investors alike could soon have access to invest in some of the most exciting technology companies of our time, from space exploration to generative AI, which have thus far been limited to private funding rounds. This democratization of ownership is generally celebrated as a win for market diversity. On the other hand, the arrival of these richly valued firms could test market capacity. An overly aggressive schedule of offerings might temporarily absorb liquidity and require careful coordination to avoid saturating investor demand. However, the consensus sentiment is optimistic. After years of lean IPO calendars, the tech community is ready to welcome its rising stars onto the public stage. The success or failure of these initial candidates will likely set the tone for how robust or cautious the rest of the IPO comeback will be. All eyes will particularly be on SpaceX's performance, a litmus test for whether the market can smoothly digest a blockbuster offering and propel it forward, potentially unlocking the door for dozens of other tech companies waiting in the wings. Topic 5. Europe cracks down. Regulatory enforcement hits tech platforms. European regulators have entered a new era of assertive enforcement, backing up years of tough talk with concrete actions and heavy penalties for tech companies that run afoul of the EU's stringent rules. Long known for writing ambitious laws, the European Union is now demonstrating its willingness to impose real consequences, marking a significant escalation in regulatory risk for both established giants and fast-growing newcomers. The Digital Services Act, DSA, and other sweeping EU legislation have moved from theoretical frameworks to potent tools in ongoing cases. Today's headlines showcase the no-nonsense approach. A major e-commerce platform has been slapped with a 9-figure fine under the DSA's mandates, reinforcing that Europe is determined to police the digital marketplace like never before. This crackdown is sending a message across the tech industry worldwide. Operating at scale in Europe now comes with serious accountability and potential financial costs if companies cannot meet the bloc's rising standards. The day's most illustrative case is the European Commission's enforcement against e-commerce upstart Temu, which was fined €200 million for failing to do enough to prevent the sale of illegal and unsafe products on its platform. This penalty is one of the largest to date under the EU's new Digital Services Act regime and underscores how regulators are targeting online marketplaces that connect consumers with third-party sellers. Temu, a Chinese-founded fast-growing shopping app, was found to have insufficient checks on counterfeit or illicit goods, making it an early high-profile test of the EU's tougher stance. The fine didn't just punish Temu, it put the entire online retail industry on alert that Europe is no longer content with issuing warnings. It will hit where it hurts, in the wallet. Officials stressed that platforms must invest seriously in content moderation and product vetting, or else face fines of up to 6% of global revenue as allowed by DSA. The Temu action thus marks a turning point from policy to practice, showing international companies that scale will be matched by scrutiny. Subtopic 1. The European Commission fined Temu €200 million for failing to curb illegal products on its marketplace. A landmark enforcement move under the new Digital Services Act that signals Europe's determination to punish noncompliance. Regulators concluded that Temu, a rapidly growing shopping app, did not sufficiently police listings for counterfeit or unsafe goods, violating obligations to protect consumers. The eye-popping fine is one of the first major financial penalties levied under the DSA since it came into effect, underscoring that the EU is wasting no time in applying its enhanced powers. Observers note that the size of the fine, equivalent to over 4% of Temu's annual revenue, is meant to be a way-up call not just to Temu, but to all large online platforms operating in Europe. Companies now face a clear choice: invest heavily in compliance, screening sellers, removing prohibited content, improving transparency, or risk substantial fines that can scale into the hundreds of millions. The Temu case establishes a concrete precedent that Europe's digital rulebook packs real teeth. Subtopic 2. Brussels' crackdown on Temu is widely seen as part of a broader enforcement wave sweeping across Europe's digital economy, ensuring that recent regulatory overhauls are put into action. Having enacted robust frameworks like the Digital Services Act and Digital Markets Act, European authorities are now leveraging these laws to hold companies accountable. Industry insiders anticipate that other platforms, from social media giants to gig economy apps, could be next on the enforcement list if found wanting in content moderation, data privacy, or competition practices. The EU's approach stands in contrast to the United States, where tech regulation often proceeds via litigation or remains gridlocked in legislation. In Europe, regulators have the mandate, and they are moving relatively quickly to implement it. The ripple effect on global companies is palpable. Compliance departments are scrambling to ensure adherence to the myriad of new rules across the EU's 27 member states. With fines like Temu's illustrating the stakes, no significant tech player can afford to ignore Europe's new digital rulebook. Subtopic 3. Temu's penalty sends a stern message particularly to fast-rising tech entrants from abroad. For example, Chinese e-commerce challengers and global apps making inroads in Europe, that they will be held to the same high standards as Silicon Valley incumbents. In past eras, big U.S. tech firms often bore the brunt of EU enforcement through antitrust cases or privacy fines, but this latest action shows the net is cast wider. European regulators made clear that any platform connecting consumers to goods or services must take responsibility for policing illegal content irrespective of its origin. That means rising stars like Temu, Shine, TikTok, or any foreign players in Europe's digital sphere cannot count on being overlooked. The Temu precedent may prompt these companies to proactively strengthen compliance to avoid becoming an easy target. It also reassures European businesses that foreign competitors won't get to skirt the rules, leveling the playing field by imposing equal oversight. Essentially, Europe's emerging strategy is neutral. Whether you're a Californian social network or a Shanghai-based marketplace, if you operate in Europe at scale, you play by Europe's rules or pay up. Subtopic 4. This robust enforcement posture in the EU highlights a deeper shift from just writing rules to actively enforcing them, a transformation that has major implications for tech business operations. In previous years, companies sometimes treated EU deadlines or compliance demands as negotiable recommendations, expecting drawn-out dialogues rather than immediate punishment. The Temu fine, coming relatively soon after the DSA's enactment, breaks that pattern. It shows that the grace period is over and enforcement is here. Moreover, Europe is bolstering its regulatory agencies with more staff and technical expertise to audit algorithms, scour marketplaces, and verify adherence, which means oversight will be continuous rather than reactive. As these agencies flex their muscles, tech firms need to incorporate rigorous compliance as a cost of doing business or risk being blindsided by fines and mandated changes. For many startups, this is a culture shock. Moving fast and breaking things doesn't fly where EU regulators are concerned. We may see an adjustment where companies preemptively build out compliance teams and processes, even at earlier stages, if they aim for European markets, given the evidence that enforcement is swift and significant. Subtopic 5. The EU's crackdown also stands in contrast to the still developing regime in the United States, where regulatory actions remain more fragmented. While Europe fines Temu for product listings and content issues, American regulators continue to rely largely on court cases, such as antitrust suits against Google or Facebook, and state-level laws to rein in tech. The divergence places companies in a tricky position of navigating very different compliance landscapes. Industry advocates in the U.S. point to EU moves like the Temu fine to argue that American governance needs to catch up with clearer rules. Meanwhile, the European assertiveness is even influencing global norms. Tech firms often implement EU standards across their entire user base rather than run separate systems, effectively exporting European regulatory influence. Therefore, the significance of Europe's crackdown extends beyond its borders, potentially raising the baseline for acceptable platform behavior worldwide. However, the lack of coordination internationally means companies must juggle varying demands, a situation that may persist until other jurisdictions either emulate the EU approach or find their own enforcement stride. Subtopic 6. Europe's regulatory heavy hand isn't limited to content moderation and e-commerce. It spans competition and privacy as well. In parallel with the Temu news, insiders report that EU watchdogs are ramping up investigations into potential abuses by established digital gatekeepers under the Digital Markets Act. They're also enforcing GDPR privacy violations with significant fines. The cumulative effect is that compliance costs are rising for tech companies in Europe, requiring robust legal, moderation, and data protection efforts. Startups can no longer ignore the compliance dimension, a fact that might slow or complicate expansions into the EU, but is considered necessary to protect consumers and markets. The motto from Brussels nowadays could well be scale responsibly or face consequences.